what are the temporary accounts? The accounts that are on the income statement are temporary accounts. They survive one accounting period. Now, in some books, dividends are temporary accounts also, and they get closed to retained earnings. In this book, which is not wrong, we debit retained earnings directly for dividends. So what has to happen, and I had a question before during the self-assessment, someone said, I wanted to record all the revenues and expenses directly in retained earnings. Is it wrong? End of period, theoretically, no. Technically it is, because we have to accumulate revenues and expenses in their individual accounts first, then we close them to retained earnings at the end of the accounting period. So that the closing process is at the end of the accounting period. It closes temporary accounts. The revenues and expenses are basically closed out to retained earnings. So the goal is to start the next accounting period with 0 revenues and 0 expenses. Because what you want to do is measure, just like your W-2 form. The first W-2 form you get for your taxes starts on January with your first paycheck in January of 2017. It excludes everything from 2016. All of that 2016 revenue and expense is now completed. Those cycles are completed. They are temporary, and they move into, and they're permanently moved into retained earnings. So the idea is to zero out revenues, which normally have a credit balance. We have to debit all the revenues. And then we credit retained earnings. And to close out expenses, which have debit balances, we have to credit each one of those expenses, and then, of course, debit retained earnings. So the process would look like this, where debit revenues, credit retained earnings for the total. So you debit all the revenue accounts you have and credit retained earnings for the total. Then you debit retained earnings for the total of expenses and credit those individual accounts. So there's 2 objectives of closing entries. One is to close out revenues, expenses to 0, and then to transfer, the second goal is to transfer those effects into retained earnings. So if you look at and again, it's a permanent account. So if we look at the T accounts, and I know we worked these through, and that's why I want to go through that comprehensive example, because it's kind of hard to see as we piece this through over the weeks, but we've built these accounts up. So what we would have to do is debit all the revenue accounts, credit all the expense accounts, and transfer those effects to retained earnings. And these are what closing entries look like. The first closing entry debits all of the revenue. So it debits sales revenue, it debits interest revenue, and credits retained earnings for the total. The second closing entry debits retained earnings for the total of all of your expenses. So you have to credit every one of those expenses. You zero those expenses out, and you debit retained earnings for the total. The difference is the net income that gets closed to retained earnings. And if you remember, the net income for the period is the difference between the revenues and the expenses. So it was $14.40, I believe, or something, $14.44, whatever the revenue was. $14.14 was the revenue. So this is the net income right here. Minus 62.46. And the net income for the period is 14.14. And that is transferred to retained earnings. So you close out all the revenues by debiting them, credit to retained earnings. Close out all the expenses by crediting them, debit retained earnings. And the difference is the net income or loss for the period. So it's a relatively simple process. This is purely bookkeeping. It's designed to zero out revenues and expenses so they start next year with a fresh 0 balance. And it permanently moves the income into your retained earnings account. And that's the goal. Relatively simple. And when that's completed, you generally take a post-closing trial balance. And by the way, if this was on an exam, so I go back, if this was on an exam, the post-closing trial balance should only include balance sheet accounts. And by the way, this is the only point at which retained earnings is the final or the correct balance. Until you close out revenues and expenses, retained earnings is not up to date. It's only up to date when you close them out to, or revenues and expenses are closed out to retained earnings. Now, talking about an exam, if you're doing a trial balance on an exam, I absolutely can't find any revenues and expenses there. Revenues and expenses cannot go on the post-closing trial balance. They have to be zero as of that point. All right, so once again, the post-closing trial balance, like any other trial balance, is designed to ensure that debits are equal to credits, that will not tell you if these are 100% accurate. All right, so that is the completion of the accounting cycle. And I'm going to now go through, let me just show you the cycle here. That's the completed cycle. Transactions are analyzed. They're recorded in the journal, posted in the ledger. You take an unadjusted trial balance. Then you record the adjusting entries. You do an adjusted trial balance, financial statements, and then closing entries and post-closing trial balance. So that is the accounting cycle. Any accounting information system that you examine or you do on your own, if it's a small company, or if you have QuickBooks or anything else like that, that's the cycle. Transaction analysis, journal, post, unadjusted trial balance, make the adjustments, you test the trial balance again, the adjusted trial balance, you close revenues and prepare the financials, close revenue and expense, and then you do your final trial balance. Now, with that said, I want to go through a complete cycle with you. So let me do that here. And I want to go through this accounting cycle illustration. So if you brought that with you, because I think it's much more complete, and it also, I think it's easier to follow because we're going to do it in one day. You know, so far we've been piecing this together, and it may not be as easy to follow. So let's go through this set of transactions for a service company, and this will kind of close out this part of the course, which is the bookkeeping part of the course. From now on, we start getting into accounting issues, accounts receivable, plant assets, issuing common stock, long-term debt. So we start now going down the balance sheet and really scrubbing all the accounts and understanding how they're valued, how we account for them. So this is the end of the bookkeeping. So I want to be sure we get this done. I want to be sure when you leave today, you've got something to say like, well, I understand that, or I don't understand it, I'm going to work on it, or I'm going to go to office hours. That's what I'm hoping that we accomplish today with the self-assessments as well as this example. So let's go through and let's start with the first, and that is to list the transactions. And I'll put the transactions up on the screen as well. So what we've done is, once again, we started our business. You got $20,000 from stockholders. You paid expenses very similar to what we did this morning. You purchased equipment on account. That might be a very minor piece of equipment, like maybe a computer with a printer and a fax machine. That's going to go into accounts payable. Then we borrowed money, signing a note at 12% interest. Cash dividends were paid. We purchased office supplies, and we paid off the entire liability from July 5th. We want you to journalize the transactions, and I'm not worried about explanations, but they'll be there. I want to open up the T accounts and post them, and then I want to get the balances of each, and in the first phase, get the unadjusted trial balance. So the first entry, and let's go through these. I'm going to go through them. Unless you stop me, I'm going to assume that you've got no questions. If you do, please stop me, because all of this right now, this bookkeeping part of this, is absolutely essential to your success, not only in this course, but going forward. So let's take the first. We had investors that gave us $20,000. We issued common stock. We debit cash, we credit common stock. Asset cash goes up. Common stock is an equity account. Cash goes up by a debit. the common stock goes up by a credit. We then post them to the T accounts, as you can see. So the cash gets posted and as a debit to cash, and we credit common stock. Any questions on that entry? Next one. We paid utilities. Now, it says paid utilities expense. If I say paid utilities, it's the same thing. Utilities, unless I say you prepaid them. Do people prepay utilities sometimes? You could. Expense. A debit, utilities expense. Expense goes up by a debit. The debit to expense will reduce income and it will reduce retained earnings, but you do not record this directly into the retained earnings account. Have to keep it separate. You got to explain to somebody where the cash went. So we debit utilities for 8. Expenses go up by debits. Cash goes down by 8 credit. And then we post them to the T accounts. Questions on entry 2 or the July 4th entry? People do work, I guess, on the 4th of July. Okay. Equipment. Now again, this said on account, we're going to say, we say accounts payable. You know, it could have been notes payable. I'd have to tell you, this could be very minor equipment for this company, like a computer with a printer, maybe a laser printer, maybe a scanning machine, whatever it is. They go out and get some office equipment from, let's say, their regular supplier. They debit the equipment, increasing the asset account equipment, and they credit accounts payable, increasing that liability. Now, at this point, any questions on anything we've done so far? Okay, so again, this is a repeat of what we did this morning, but I just want to build the whole cycle. July 10th, services on account for a client. There is a service provided, so revenue is recognized by a credit. You did not get paid. Revenues are asset inflows. Those assets could be receivables, they could be cash. In this case, it's a receivable. We debit accounts receivable to increase the asset. We credit the revenue to increase the revenue. And then we post them to the T accounts. Even though the cash is not collected, that is, in fact, a revenue earned during this period. And it has to be recognized. Questions on the revenue? Recognized. Any questions on revenue? If you call that sales revenue, service revenue, sales commissions, whatever it is, it's got to be a separate revenue account. You cannot credit stockholders' equity directly. You cannot credit retained earnings directly. Now, we sign a note. We're borrowing money. Cash comes in. Cash comes in by, and it's a financing cash flow. We debit cash to increase it by 14. The liability, notes payable, goes up. We increase that by 14. Notice, right now, the cash balance is being built up and reduced by those transactions. Questions on the note? Dividends. In this book, cash dividends go directly to retained earnings. Dividends are not expenses. We debit retained earnings by reducing retained earnings by a debit, and we reduce the asset cash by a credit. And now, of course, again, we're moving cash in and out of the business. Debit retained earnings. The normal balance of retained earnings is a credit. Right now, it's a debit. Why not? Why? Because we haven't closed out revenue and expense yet. Until we do that, the account is sitting there with a debit balance. Questions on the dividends? Because again, dividends are, in this book, not a separate account. You might see other books, you might go to clients that have dividends accumulated separately, which I could see the benefit because it provides more information. Remember, anytime you net something out or bury numbers in accounts, you lose information. Even before, when I did the compound entry with the wages, somehow it does obscure information for some of us, and it's always better sometimes to see the disaggregated numbers. Okay, and finally, we buy office supplies. It's an asset. They are not used up yet. They have future economic benefit. In some cases, you will debit the office supplies if you buy them and use them at the same time. In this case, they're unused, so they still have asset value. Debit the asset to increase it, 16. Reduce the asset cash by 1,600 by a credit. Now again, what you have to do is look at the wording. I know it's not easy at this point. You're going to make your mistakes. Did I purchase the office supplies? Some of you might debit the expense. In this case, I think it'll become clear that when you first buy them, they have future economic benefit. There's absolutely no loss of value at that point. Now, we will have to examine that account to determine whether there is loss of value. Okay, and finally, we pay off the liabilities for the accounts payable. We're going to debit the accounts payable to reduce the liability. Notice we reduce it to 0, so there's no balance in that account. And we reduce cash by a credit. So right now, those are the transactions for the month of July. When we look at the ledger, which we will in a second, we'll get the current balances. Before I go to the ledger, that's the first step. Transactions analysis, journalize, and posting. So that's the first two steps, I should say, of the cycle. Transaction analysis, journalize, and post, and that's what we've done. Anyone with anything that you'd like to see again, any questions about anything, any curiosity, any extension of what we've done with a question? Now, here are the ledger accounts. So we've done this morning, and I'm sort of framing today's session with, bookkeeping, and we're going to end it with some bookkeeping. All right, so here are your accounts. These are the cash balances, 26.4. Accounts receivable has a balance of 4. Office supplies, debit balance of 16. Equipment, and this is the way, don't forget, this morning looking at a simulated exam, I'm haphazardly opening accounts. If I ask you to do T accounts on an exam, I would not ask you to sit there and say, all right, I'm going to build a chart of accounts and all the assets come from, no, just get them done, post them. But here, of course, systematically, if you had a chart of accounts and you were examining your client's ledger, you can be sure that cash, receivables, it's in order of liquidity, it's in balance sheet order. So the assets come first, then the liabilities. Accounts payable has a 0 balance, notes payable has a liability balance, credit of 14. Then the equities, common stock, credit balance of 20, and retained earnings, debit balance, now that's not the normal balance, right? So basically I know that I got to look into this, and I'd look into it, say, oh, well, I didn't close the revenues and expenses yet. That's why there's a debit balance. By the way, if over time, and you'll see some companies, hopefully they're none of your clients, but you'll see companies with deficit balances. You could carry a debit and deficit balance in retained earnings. I mean, there are companies that lose more money than they make, or pay dividends even when they have negative retained earnings. Dividends, by the way, are not really distributions of current or past earnings. They're future expectations. So that's why if a company cuts dividends, the market picks it up as a future decline in earnings, not a current decline in earnings. So if you have a loss and still pay your dividend, the market has some confidence that you are going to have future earnings. So dividends are paid based on future expectations. So, all right, retained earnings, we'll get back to that, does not have the normal balance. Service revenue, credit balance of, and now we get the revenues and expenses. These are the sub-equity accounts, if you like, or the sub-accounts for retained earnings. Expenses, utilities are 8. And now we can prepare the unadjusted trial balance. So all we do in the unadjusted trial balance is to take the ending balances, put them in their debit and credit columns. Debits are equal to credits. Does that mean that it's correct? No, but it just ensures that the bookkeeping, to your knowledge, is correct. So a trial balance is not a financial statement. It is an internal document. It is to ensure that debits equal credits. So in many cases, I ask for a balance sheet on the exam and I get a trial balance. This is not a financial statement. It's not a balance sheet. You just list all of the accounts, and you notice that they're in financial statement order. Assets, current assets first, long-term assets. Liabilities, current, non-current liabilities. Equities, common stock, retained earnings, then revenues and expenses. So the way you list them is in financial statement order. Balance sheet accounts first, and then income statement accounts. So that is your unadjusted trial balance. Now, in the event that you are not going to prepare financial statements, you could start recording for August if you wanted to. But we are going to prepare financials. So the next step, once again, transaction analysis, journalize and post, unadjusted trial balance, now for the adjustments. So picking up where we were today, I give you information for the adjustment process. The equipment they acquired on July 5th has a 10-year life, and even though it's on July 5th, we're not going to start calculating depreciation by the day. We're going to move it back and take it for the full month of July. Interest accrued on the note, I'm going to tell you it's $140, and the inventory of supplies taken at the end of the month tells me I have $1,000 left in the supplies account. So now I've got to go ahead and make these adjusting entries. Now before I do anything, let me just see what I have here. If I go back and I take a look at the office supplies account, the office supplies account, let me make sure I have that correct on my, yeah, it's there, right? Yeah, okay. So the office supplies account is sitting there with $1,600 in office supplies. So I'm telling you that you go out, you take an inventory of the supplies, then you come back and you tell the accountants, look, I counted that there were 1,000 left. So what's the adjustment? If you're not, you could always do this. You say, wait a minute. Got to have 1,000 in there. You know what? I got to reduce the office supplies by 600. So that's the way you might want to look at it. You might want to go into the T accounts, and see what accounts need adjustment. So certainly you're going to have to adjust this account, and the office supplies expense is going to be 600. So I'm going to have to make an entry debiting the office supplies expense and crediting office supplies. So that's how I get that adjustment number. Now, I could have, let me go back, and I'll go back to this if you need to. But what I could have done is in the adjustment data, I could have said here that office supplies of 600 were used up. Could have done that directly, or I could have asked you to do a little extra work. So either way, you get the same result. Now, any questions on the adjustment data? So you're going to have to do a calculation on depreciation. I'm giving you the interest that's accrued, and I just showed you that you have to expend 600 of those supplies. And then, of course, I want you to journalize the adjusting entries, post them to the T accounts, get the balance of each account, do an adjusted trial balance, and then prepare the financials, and then finish the cycle with the closing entries. All right. Here are the adjusting entries, and Avi asked the question before, at the end of the month, do I designate a special section? Yeah, I mean, I'm going to, in most bookkeeping scenarios, they will tell you to set up a separate section of the ledger, the general ledger, for adjusting entries, and that says adjusting entries. Now, for depreciation, I need to depreciate this asset. There was no scrap value, so I'm going to straight line this, $420 per year. Per month, it's $35. So I'm going to debit the depreciation expense and credit the accumulated for $35. Interest is given to you as accrued, so I debit the interest expense, credit the interest payable, and the office supplies. Office supplies, again, is the classic deferral, classic case. You got to go back into the accounts, see what's recorded, and then make your adjustment. So you started with 16, it's ending with 1,000, you used up 6. You debit office supplies expense, and you credit the office supplies. All right, so keeping it simple, I wanted to tie this together with one example, realizing that using, the original textbook slides is kind of difficult because we've been doing this for the last, 2 sessions. So, or at least half last time in this full session. So, questions on the adjustments? All right, so we had 2 deferrals and 1 accrual. That's an accrued adjustment. All right, now, we're going to post these. So notice right now, the only adjustment I have, cash is fine, cash receivables unadjusted, didn't do anything to equipment yet because we use one account here for depreciation. Accumulated depreciation, we're going to use the contra account here, but I do adjust the supplies down to 1,000. So I'm designating this as the July 31st adjusting entry in my ledger accounts. And then moving to the accumulated account, I'm going to show the accumulated, the contra account adjusted at 35. No adjustment to accounts payable, no adjustment to notes payable, but I set up a separate interest payable account. I debited interest expense and I credited interest payable. Questions on those adjustments? Okay, we're just posting the journal entries. Okay, and then of course, nothing happened to common stock, retained earnings, service revenue is okay, no change there, nothing accrued. Utilities expense was not accrued, interest expense was accrued. Now, by the way, that's an account you didn't have before. So what I wanted you to recognize when you go over this again is that from the unadjusted trial balance to the adjusted trial balance, you had to open up new accounts. Accumulated depreciation didn't exist until I made those adjustments. Interest expense didn't exist until I made that adjustment. Also, depreciation expense didn't exist, neither did the office supplies. So those expense accounts are opened up in the adjustment process. They're new accounts that I open up. Now, they could have been there obviously with 0 balances, but we just opened them up for this period. All right, so now, moving along, analyzing the transaction, journalizing, posting, unadjusted trial balance. Adjusted trial balance coming up next. We booked the adjustments, now we have to go to the adjusted trial balance. Before I do that, any questions so far? Here it is. This is the adjusted trial balance. So now all of the revenues and expenses, assets, liabilities have been adjusted. Just notice that retained earnings is the only account that is still not 100% correct because it is not yet reflecting the closing of the revenues and expenses. It only reflects the dividends. So that is not correct. You can't prepare financial statements using that retained earnings. He wants to set up over there. If the smell of pizza doesn't bother you, tell him he could set up on that back table. If you want to set up on that back table, you could. The other door. Actually, it might wake you up. All right. So again, let me make sure that that is clear. Is everyone clear that this retained earnings now, even if it had 0 balance, is not correct? That is the opening balance of retained earnings. It is not correct. It still does not reflect the revenues and expenses. Now, the adjusted trial balance is used to prepare financial statements. You cannot prepare financial statements unless you've got the adjusted trial balance. So the adjusted trial balance becomes the basis. So what I'm going to do is I'm going to take, except for this number, right? I'm going to take the numbers that we have here, and we're going to use them to prepare financial statements. What statement is prepared first? We got 4 statements. We're not going to do cash flow right now. What's first? Income statement has to be prepared first because I need to know the net income that's going to go into retained earnings. That retained earnings has to be adjusted. Income statement is first. Second, the statement of stockholders' equity. Next, the balance sheet, and then we'd have cash flow would be last. So let me put this up on the screen. These are the adjusted trial balance numbers. Let me just zoom in there a little bit. So what we need to do is start with the income statement. So the income statement is going to be taken directly from the adjusted trial balance. So the sales revenue of $4,000, and then the operating expenses. I'm going to start with, and by the way, how do you list operating expenses? We said assets on the balance sheet are listed in the order of liquidity. We said that the liabilities are listed in the order of maturity. How do we list expenses? You want to sign for that? I'll do it. Okay. Sorry about that. It's only $125. Tell my wife I debited the 2 days. In case I get stuck with the bill. Okay. Anyway, so you got your $4,000 coming off the adjusted trial balance. That could have been adjusted for accrued revenues, right? So you got $4,000. Expenses, how do I list them here? If there's no reason to put one expense before another, it's usually in order of magnitude. So the largest expense is utilities, $800, taking that right off the adjusted trial balance. Then I've got the office supplies, interest, and then depreciation. What's a good reason to list one expense over another? Would Johnson & Johnson want you to see their research and development first? Right? Research companies, companies that do lots of R&D, maybe they want that expense first. Right? If it's a sales company, maybe they want their sales force numbers up front. So, it really depends on the company. Total operating expenses, $1,575. Net income after tax. We're living in a no tax world right now. So you've got $2,425. That is your net income. Now, taking that net income, and we're going to need to move that into the balance sheet. Now, we could prepare, although I'm not preparing it here, we could prepare a statement of stockholders' equity, but it's really simple. What I wanted to show you is that retained earnings now would reflect what? Net income minus the dividends. So your retained earnings account should be at $1,425. So I'm not showing you a separate statement of stockholders' equity, but if you wanted to, you could say that in the stockholders' equity section, common stock is 20, retained earnings. The beginning balance was 0, like we just started. The net income. And the net income had to come from the income statement. Let me put that back up on the screen. So net income comes from the income statement, $2,425. Dividends are $1,000, and then the ending balance put out here is $1,425. So that's your ending stockholders' equity, $21,425. All right, so that would be your statement of stockholders' equity. That would be prepared before the balance sheet in order to get that number. And then, of course, all of the other accounts. I'm going to make a couple of comments about the assets in a minute. But on the asset side, you have cash, $26,004, accounts receivable, $4,000, office supplies, $1,000. And you notice the way I reported the equipment? I'm reporting that net of accumulated depreciation. So it really depends on the balance sheet. You could show it grossed up minus the accumulated, but typically on published financial statements, you're going to see it this way. You're going to see the equipment net of the accumulated. So if you wanted to on the exam, you're not wrong. If you put the equipment grossed up at 42 minus the 35 of accumulated, you could do that. That's not a problem. And then, of course, accounts payable is 0. Interest payable is 140. Notes payable 14. And then, of course, the balance sheet will balance. So income statement, stockholders' equity second, balance sheet third. Here, you really need much of a stockholders' equity statement because all you had to remember was to take the dividends out of the net income. Questions on adjusted trial balance, income statement, stockholders' equity statement, and the balance sheet. Last but not least, we're going to have to do post-closing, closing entries, and then the post-closing trial balance. Now, the closing entries require that we close out all revenues and expenses to retained earnings. The first closing entry debits all of our revenues and credits retained earnings. The second closing entry debits debits the sum of all of the expenses, $1,575, and credits individual expense accounts. So right now, when we go to the ledger, these are balance sheet accounts unaffected. First account that's closed out is service revenue, 0 balance. Right? So once we post the closing entries, you got a 0 balance. And then all of the expenses, so all your expenses are right there. They're all closed out. Every one of those expenses, and I'm going to go back to the retained earnings in a second, every one of those expenses is credited and now has a 0 balance. So every one of them is 0, so that next year you could start accumulating those revenues and expenses again. And if we go up again to the retained earnings, notice that the retained earnings now is at its ending balance. It's correct at 1425. And of course, the idea is that we closed out the revenues and expenses by debiting retained earnings for 1575, and the other that should have been up. The other closing entry, it is there. The other closing entry up on top is 4,000 on the credit side. So all the revenues and expenses are 0. All of the revenues and expenses now have been transferred permanently to retained earnings, and that now closes out the cycle. The only thing you have to do, and I'll take questions in a minute, but the only thing you have to do at this point is prepare the post-closing trial balance. The post-closing trial balance only includes balance sheet accounts. Every income statement account is now 0. And at this point, the retained earnings account is correctly stated at 1425. So that is the entire accounting cycle.